bearish candle or series of large-bodied bearish candles that sweep sell-side liquidity and then lead to a break of an old high right after it, which in this case is called a break of structure. The order block occurs at the open of the large-bodied bearish candle that sweeps sell-side liquidity. Price will often retrace back to the order block before moving higher. The bearish variation of an order block is formed by the large body bullish candle or series of large body bullish candles that sweep buy-side liquidity and then lead to a break of an old low right after it, which in this case is called break of structure. The order block occurs at the open of the large body bullish candle that sweeps buy-side liquidity. Price will often retrace back to the order block before moving lower. Notice that high probability order blocks come from simple expanding pivot formations where a lower low is followed by a higher high in the case of a bullish order block, or when a higher high is followed by a lower low in the case of a bearish order block. We also have the low probability order blocks, which are formed by small body candles with more prominent shadows occurring in the middle of a single price movement. These can also be divided into their bullish and bearish variations. In the bullish variation of a low probability order block, we find a small-bodied bearish candle in the middle of a price movement composed by mostly bullish candles. The order block sits in the space between the high and the open of the small-body bearish candle. Price will often retrace to this order block before resuming the movement upwards. In the bearish variation of a low probability order block, we find a small-body bullish candle in the middle of a price movement composed by mostly bearish candles. The order block sits in the space between the low and the open of the small body bullish candle. Price will often retrace to this order block before resuming the movement downwards. Let's take a look at an example of a high probability bullish order block in a real price chart. In this chart, you can see that I marked out the latest swing low highlighting a sell side liquidity level. Recall that in a bullish high probability order block, you must identify the sweep of sell side liquidity first. In this next chart, we can see that sell-side liquidity is swept by a large body bearish candle. Notice also that the upper tail of the previous candle forms a swing high. We want price to break this latest swing high. That would be the very next step for us to use an order block in this case. Moving price forward a few candles, we can identify a break of structure, meaning that price rises and breaks the latest swing high. In summary, we swept the sell-side liquidity and failed to move down after it. Price comes back up and breaks market structure. This is a setup for a high probability order block. In this case, the order block sits in the opening price of the large body bearish candle that swept sell-side liquidity. Price will often retrace back to the order block, as you can see here, which would be the long trade setup, and then price goes to the upside as expected, as you can see in this final chart. There are a couple of important details in here. Notice that price touches the order block 2 times before going to the upside, which would be the opportunity for a secondary entry in case you missed the first touch. Beyond that, we can also see a low probability bullish order block working, as you can see in this area. A small-bodied bearish candle in the middle of a bullish movement where we mark the distance between the high and the open. Observe how price action comes back to this area right after and goes up from there. Let's move on now to a real example of a high probability bearish order block where we use another type of entry called mean threshold instead of using the opening price of a large body bullish candle as the order block. In this chart, I marked out the buy side liquidity level and we can see price approaching that level. This is the moment you begin to anticipate a liquidity sweep. In this next chart, you can see that price sweeps buy side liquidity and then fails to move higher. Notice also that a new swing low just formed, so if price breaks it to the downside, we can look for an order block setup, this time looking for the mean threshold of the order block. In this situation, the order block is the large body bullish candle that leads to the liquidity sweep. The mean threshold is the 50% Fibonacci retracement from the open to the close of that candle, as you can see here. In this next chart, we can see price breaking the last swing low. The setup now consists in waiting for price to retrace back to the mean threshold of the order block. Advancing a few candles into the future, we can see price retracing back up and meeting the mean threshold, and right after that, price goes down, completing the bearish order block setup. An interesting detail here is that we can spot that a low probability order block formed in the same level of the mean threshold of the high probability order block. As is the case with any method, the trader must find the intersection of techniques in order to find the best trades. The final ICT concept we'll study in this beginner's guide is the daily bias.